Imagine this. You invest in a piece of blue-chip art with a world-famous name attached to it, only to discover years later that it's barely worth what you paid. This happens more often than you think. The blue-chip art market boasts an impressive 7.5% average annual return over the past 25 years, outperforming many traditional assets. But beneath that headline figure lies a landscape filled with volatility, opacity, and risks that can catch even experienced investors off guard. In this video, we'll break down 5 structural traps that can undermine your returns. Each of these pitfalls exposes how brand recognition can mask real dangers. Let's start with the first and perhaps most overlooked trap. What if that Picasso you just bought didn't live up to its legendary name? The real issue often comes down to the medium. Many investors believe that any work by a renowned artist is a safe bet, but this overlooks a critical distinction between unique artworks and editioned prints. The blue-chip art market's headline return of 7.5% a year looks appealing, but the print market tells a different story. Between 2006 and 2016, prints delivered a geometric mean annual return of minus 0.31%. The Sharpe ratio for prints over this period was just 0.0356, meaning the small returns did not justify the risk. This underperformance highlights how brand recognition alone can mislead investors into thinking all works by a famous artist are equal in investment potential. Pablo Picasso's market is a clear example. His original paintings regularly achieve multi-million-dollar sales and dominate auction headlines. In contrast, most of his prints, lithographs and etchings from large editions, sell for between $1,250 and $6,250. While Picasso's name ensures steady demand, prints simply don't offer the scarcity or cultural significance of his unique works. Andy Warhol's market shows a similar pattern. His 1964 painting, Shot Sage Blue Marilyn, sold for $195 million in 2022, while only the rarest, complete, signed portfolios of his prints, such as the Endangered Species series, which sold for $3.6 million in 2021, reached the low millions. Most prints, especially unsigned or open editions, are valued more for their decorative appeal than as serious investments. As Rose Frederick puts it, prints lack scarcity and human craftsmanship, beautiful but not investment grade. Liquidity is also a concern. The secondary market for prints is much less robust than for unique works, and open editions or posthumous reproductions often have little or no resale value. Top collectors and auction houses focus on rare, unique pieces, leaving most prints to entry-level buyers or decor markets. Even experienced investors can be drawn in by a big name and miss these crucial differences. In the art market, understanding the medium is as important as recognizing the artist. But the risks don't end there. Sometimes it's the excitement around a name itself that creates the next major pitfall for investors. The art world's fascination with emerging talent often fuels dramatic price surges, sometimes followed by equally steep corrections. This phenomenon, known as the hype artist bubble, has become a defining feature of the ultra-contemporary market. Speculative bubbles emerge when powerhouse galleries and aggressive media coverage propel young artists into the spotlight. The resulting frenzy can push valuations to unsustainable heights. From 2017 to 2022, the ultra-contemporary sector surged by 557%, attracting attention from both casual collectors and institutional investors. But the correction was swift and severe. In 2023-2024, the sector fell by 37.9%, following a 25.1% contraction the previous year. These rapid reversals highlight just how fragile momentum-driven valuations can be. Oscar Murillo's career offers a clear example of this cycle. After his market took off in 2014, one of his paintings sold for $401,000 at auction, far exceeding expectations. Over the next decade, Murillo's work became emblematic of the hype-driven market. By 2023, however, his average auction price had dropped to $107,894, and by 2024, his average realized price had fallen 25% year over year. This sharp adjustment mirrored the broader contraction in the ultra-contemporary sector, illustrating how quickly enthusiasm can fade and prices can recalibrate. Industry expert Lisa Schiff observes, auctioning young artists creates an artificial market that rarely holds. Traditionally, artists built reputations over decades, with demand growing alongside their achievements. When this process is compressed, the resulting price corrections can be dramatic, leaving recent buyers exposed to significant losses if the market's attention shifts elsewhere. Momentum can be seductive when prices are climbing, but in the art market, rapid gains often signal underlying instability rather than lasting value. Now we'll show how simply owning art can cost you as much as the purchase price itself. Owning art involves much more than the hammer price, and the true costs often catch investors off guard. The hidden costs trap centres around the total cost of ownership, expenses that quietly erode returns and are rarely mentioned in headline auction results. The largest immediate expense is the buyer's premium, a fee paid directly to the auction house on top of the hammer price. At major houses like Sotheby's and Christie's, this premium is 26 to 27% for works up to $1 million. For purchases above that, the rate drops to around 21 to 22%, and for pieces over $6 million, it can go as low as 14.5% to 15%. For example, if you win a $1 million painting at Sotheby's, you'll owe an additional $270,000 in buyer's premium, money that doesn't increase your equity in the artwork, but simply facilitates the sale. Auction headlines never include this fee, which means the true financial commitment is often much higher than it appears. Beyond the initial purchase, ongoing costs add up. Fine art insurance premiums typically range from 0.1% to 1% of the artwork's value each year. Professional storage is another recurring expense. Arrow Fine Art Services in New York, for instance, charges $5.50 per square foot per month, with a minimum monthly fee of $175. Over 5 years, insuring a $1 million painting at a conservative 0.25% rate totals $12,500, while storage adds $3,300 annually. Altogether, the 5-year cost of ownership rises to $1,302,375, over $302,000 above the initial hammer price. This figure excludes sellers' commissions, which can add another 10 to 17% at resale, further cutting into potential profits. Many investors overlook these ongoing expenses and focus on impressive auction numbers, but without factoring in these hidden costs, even a strong sale result can translate to disappointing net returns. And while costs chip away at value, there's another risk that can undermine your investment entirely, a risk rooted not in numbers, but in the story behind the artwork itself. Provenance is the art world's equivalent of a legal title deed, and its strength or weakness can make or break any investment. The poor provenance trap centres on this. Without a verified, gap-free record of ownership, even the most impressive artwork can become unsellable. Bulletproof provenance means a verified chain of ownership, catalogue raisonné inclusion, and documented exhibitions, no gaps allowed. This isn't just about paperwork, it's about market confidence, legal clarity, and the ability to insure, finance, or resell the work. A strong provenance acts as an artwork's biography, tracing its journey from the artist's studio to the present day. Key components include inclusion in the artist's catalogue raisonné, an unbroken ownership record, documentation of museum or gallery exhibitions, and physical evidence such as gallery labels or auction house tags. If any part of this chain is missing, the risks multiply. Any vague line like Private Collection Europe should set off alarm bells, especially if the seller can't provide more detail. Gaps in provenance, particularly during periods like World War II, can signal legal or ethical issues that may never be resolved. The Gurlitt collection is a stark reminder of how flawed provenance can destroy value. In 2012, German authorities discovered over 1,500 artworks hidden in Cornelius Gurlitt's Munich apartment. Early media estimated the stash at $1 billion, but this figure quickly unraveled when it became clear that much of the collection had dubious origins. Many works had been acquired by Hildebrand Gurlitt for the Nazi regime, often from Jewish collectors under duress. The collection's value evaporated as legal disputes and ethical questions emerged, leaving major buyers unwilling to take the risk. Legal and reputational risks tied to poor provenance can result in forfeiture, lawsuits, or an inability to sell or insure the work. In the art market, a clean, documented history is often worth more than the artist's name. And just when you think you've covered provenance, the forgery risk might be the biggest shock of all. Imagine up to 90% of Salvador Dali prints in circulation are fakes. This isn't an isolated problem. Estimates suggest that 40 to 50% of artwork on the market may have authenticity issues, including outright forgeries, misattributions, and works with unverifiable origins. Even high-profile artists and established galleries are not immune to this risk. The Knoedler Gallery scandal stands as a cautionary tale for investors. Knoedler, founded in 1846 and once the oldest gallery in Manhattan, sold more than $60 million in forged paintings between 1994 and 2009. The fakes, attributed to major names like Mark Rothko and Jackson Pollock, were painted by Pei Shen Chen and funneled through dealer Glafira Rosales. The gallery's reputation gave these works instant credibility, deceiving buyers and even experts. Forensic analysis ultimately exposed the fraud, revealing that some paintings contained pigments not invented until after the supposed artist's death, a clear technical red flag that overrode subjective expert opinion. This case showed how easily trust in brand names and institutions can be exploited. The art market's lack of regulation, combined with its reliance on subjective assessments, creates an environment where sophisticated forgeries can circulate for years before discovery. Many buyers assumed the gallery's standing guaranteed authenticity, neglecting to pursue independent verification or forensic testing. Robert Norton, CEO of Verisart, warns that art is the second largest unregulated market, a space where due diligence is now non-negotiable. Relying on reputation or instinct is no longer enough. Investors must insist on rigorous provenance research, technical analysis, and independent authentication before committing capital. With these risks in mind, it becomes clear that the blue-chip art market is far more complex and volatile than surface numbers suggest. To succeed in art investing, you need to look past the surface and focus on the fundamentals. The 5 traps, wrong medium, hype bubbles, hidden costs, poor provenance, and forgeries show that relying on a famous name alone is rarely enough to protect your capital. Each risk demands careful analysis and a willingness to ask difficult questions. Successful collectors approach art as a complex asset class, not a simple luxury purchase. If you found these insights useful, hit subscribe and share your own art investing lessons in the comments. Remember, treat art like an asset, not a status symbol.